When you buy an index fund, you own the good, the bad, and the ugly. And that's why we don't believe in index funds at Falcon Wealth Advisors. And the worst thing to do would be to buy an index fund and pay an advisor an ongoing fee for that index fund.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Hello, Jake. Thanks for having me. How you doing?
Oh, you asked me. Well, we were just talking before I hit the record button. I just finished up another tournament round of golf and wasn't my best. So I was really excited to go home and take a shower and come to work.
Yep. One of those rounds, huh?
So golf is not my job. I do it for fun and the challenge. I do like to practice and get better. So don't get me wrong. I'm not like a casual golfer. However, this is what I am good at, and I'll keep doing this. So rest assured, Upticks is still going to keep rolling. I'm not going to quit to go pursue my golf career. What about you, Cory? What's new with you?
Cassie and I did a 4D sonogram this morning, Jake. I don't know if you know about this.
4D?
4D, four-dimensional. Yeah, we could actually get a pretty good visual of the baby.
That's cool.
It's pretty neat. Yeah, it's pretty special. It was pretty neat to see. She's due on June 13th. So we're at the point now where actually tomorrow will be 34 weeks for her. So we're coming down to crunch time, but it was really neat. It was fun to see here today. That technology has really come a long way.
Now, was it an emotional moment? Did you guys like tear up?
Mm-hmm. Yeah, it was emotional, definitely.
That's awesome. Well, congrats.
I feel like I'd be crazy if that was not emotional, but that's just me.
Maybe not.
Different. Everyone's different.
That makes you crazy. I don't think it makes you crazy if you're not emotional about it. I was just curious.
Yep. For us, definitely.
Good. Well, I did want to bring up one topic, Cory, before we get into today's headlines. So do you mind queuing that up?
Yes. Investors, be aware of overconfidence in investing because it can mess things up.
Right. So I just want, again, I don't want to pick on anybody here, but I want to bring awareness that, certain sectors of the market, mainly the tech sector, have done very well recently. And some of our clients either are casual do-it-yourselfers, they like to dabble, they like to play. And my point of this, Cory, is I just don't want to see people get burned. And I don't want you to think if you've picked 1, 2, 3, 4 stocks that have gone hyperbolic in your portfolio over the last couple of years, that this makes you some sort of market expert or guru, because it doesn't. And again, I'm happy for you if you've made a ton of money. If you're watching this or listening to this and you've done very well, great. I truly am happy for those people. However, Cory, you and I have been doing this long enough to know that things cycle. And so the prudent thing is to rebalance, sell things, trim, and not get greedy, right? Don't get greedy, just like we don't want people to get fearful. And this all kind of stemmed from a conversation a client had about short-term capital gains and their account. And I just want to make this clear for our clients that at Falcon Wealth Advisors, Cory, we certainly are tax sensitive, right? We want to make sure that our clients are not overpaying Uncle Sam in taxes and that we're doing proper tax planning. That does come secondary, though, to investment performance. Our traders and our investment management group, they know that if a client has an opportunity to lock in a gain or sell something, we're going to do that regardless of the tax implications, unless a client has a very specific request that we're managing. Because in the end, gains are good. It means you made money. Right? It means you made money. So the opposite of that would be losses, which helps your taxes, but does not help your financial plan. So I just wanted to make a quick public service announcement saying, hey, First, that's great. If you've made money here recently, that's awesome. Let's not get overconfident or cocky. Maybe you're managing some money on your own. Maybe now is the time to rebalance and sell some things, even if that means you have to pay some taxes. And that's kind of what I want to just get out there, because I think it's a very common misconception, and I want people to be aware of it. And that's the whole point of this show.
That's good. I'm glad you mentioned that, Jake, because my experience with it, with what you're talking about here today, is just as far as overconfidence goes. And really, it all ties into, trying to predict the future, in my opinion. A lot of that can tie into it. But I've experienced it enough, and I'm sure you have too, with clients, where we've all been there, where we've had certain picks that have felt great. And then there's also market conditions that make people feel like they're really silly or they have no idea what they're doing. And I think your whole point is, let's avoid that situation.
Right. Exactly. Good. Thank you, Cory. And speaking of Upticks, again, our subscriber count continues to grow. So if you're watching or listening to Upticks, a 5-star rating or a thumbs up will be greatly appreciated. Please like and share our content. We're doing this to enhance financial literacy, and hopefully everyone that's tuning in is getting something out of today's episode. All right, Cory, with that,
play ball.
Play ball. Here we go.
All right, Jake. So first, we have time spent worrying about money.
Yeah, and I got this from your friend now, Cory, Carl Richards. I beat you to it.
You did beat me to it.
And
you
I got
a few articles.
I know I did. I've been on it. So I did want to just read it. It's very short, but I want to read it because I'm not going to do a good enough job summarizing it because I thought it was really good. So bear with me here. This is a quote from Carl Richards. Just about every month, he says he gets pitched some cool new investment opportunity, whether it's his brother-in-law wanting to buy real estate or a friend starting a legitimate business. And he says, Cory, he used to go down these financial rabbit holes like we all have, right? He's talking literally weeks of his time talking about it, researching it, considering it. Have you done this? I have. Have you?
I have.
Okay. All right. So he said one day, in an act of frustration, he paused and asked himself some pretty basic questions, which I want to encourage our audience to do the same. Why am I doing this? What does money mean to me? He said he grabbed a Sharpie and wrote the answer on a piece of cardstock. And his answer, Cory, is time with my family, mainly outside, and serving in my community and church. That's what he wrote, okay? That's what's important to him. That's what money means to him. And so now he says, every time a new opportunity comes up, he doesn't have to spend so much time thinking about it. He'll just go back to his index card, right, or whatever he wrote it on, and he says, can I be sure this investment opportunity gets me closer to those goals? And when he's honest with himself, the answer is almost always no. So he started calling this card his one-page financial plan. But he said you can call it whatever you want, a statement, a touchstone. I would call it a purpose, personally, Cory. A reminder of what you said was important to you when you were thinking clearly. He said even if it's on a sticky note on your laptop or mirror, right, in your bathroom mirror, that's better than having no plan and will save you hundreds of hours each year. My comments were, Cory, this is so good. Stick with your plan and ignore the rest. I thought it was really good. You have any comments on this?
That is really good. He's keeping it simple, which I think is what works for a lot of people. It works for most people. And it's almost where a lot of people need to start, because his point here about getting down to the basic foundation of why he was doing what he was doing and why it was important to him, I think that's true, Jake, for you, for me, for everyone else, right? We need to know the answers to those questions. We need to consider that when we're thinking about your financial plan, your investment portfolio, because that really can help to drive. My point of view is like it really just puts constraints around it rather than getting distracted by every shiny new toy or opportunity that might come your way. It just puts constraints around what's important, and it helps making decisions simpler almost.
Yeah, and I don't want people to think of constraints in a negative connotation. It's a good thing. It's a good thing to limit yourself. Think about if you wanted to eat every dessert that was out there, right? You wanted to have cake and ice cream and cookies and Little Debbie's and jelly beans, and you did that every day, or you thought about that every day. I mean, that wouldn't be good for your body and your health. So why is looking at all of these esoteric investments alluring to people? Is because of greed, normally. However, if you've got a financial plan, which all of our clients at Falcon Wealth Advisors should, if you don't, you should, typically they do. Let's go back to the plan. Does cryptocurrency get you closer to those goals? Do meme stocks, right? Does your brother's, sister's, mother's dog stock tip have anything to do with your financial plan? Most of the times it's not. Let's stay focused on that. Good, Cory. Thank you for indulging me. Uh-oh. Are you kidding me, Cory? We have a chart?
Did you not?
All right. I think it's just to cue it up here. You just got a chart, right? You want to go into it?
I do. Yes. So this is from Strategas Research Partners. They published recently a research report on charts worth watching. Just one I wanted to point out here today, Jake, because I wanted to get your take on this. There is an all-time high concentration for the 10 largest stocks in the S&P 500. And that's what's reflected on this chart here. This is showing us going back to the early 90s. What percentage of the S&P 500 the 10 biggest companies have made up? And it is at 33.5%. So the S&P 500 is influenced, 33% of the returns are influenced by 10 companies.
Wow.
What's your take on that? What do you take away when you look at that and think about that?
I think that's why index investing doesn't make sense for most people, because it used to be a diversification strategy.
Right.
It's not that way anymore. It doesn't work that way anymore. And, if you're just going to think you can buy the S&P 500 and you're going to be quote unquote safe, I think that's what your chart is telling me, is that that's not necessarily the case, right? Now, a third of a portfolio, 10 stocks. The problem is that index is comprised of 500 companies. That's the problem.
Exactly.
Because I don't have such a problem with 10 stocks making up. I mean, again, this is not advice. I don't think that's the horrible part. I think the horrible part is that when people look at the S&P 500, they think it's much more equally distributed, and it's not. And so, again, and we've talked about this on the show before, Cory, when you buy an index fund, you own the good, the bad, and the ugly. And that's why we don't believe in index funds at Falcon Wealth Advisors. And the worst thing to do would be to buy an index fund and pay an advisor an ongoing fee for that index fund, Cory. That is ridiculous, because now you're not only just succumbed to the good, bad, and ugly of the index, now you're paying an advisor a fee to underperform that index.
Yeah, the low-cost index fund is not so low cost anymore.
Becomes high cost. So thank you for that chart, Cory. I still don't like it. I don't like charts, but I appreciate you sharing.
I do. I think it illustrates a good point.
Yeah. It's fine. It's a chart. What's
All right,
next?
Jake. We'll move past it. Wall Street steered billions to blacklisted Chinese companies. A House probe finds.
Oh, Cory, it's like you read my mind. Speaking of index funds, did you know that basically, again, index funds owned blacklisted Chinese companies? So your retirement money, Cory, not you, just saying in general, your retirement money could be invested in companies that are supporting the Chinese military and supporting human rights issues. And you know what's crazy, Cory? And this is what's really messed up about this article, is that it's not illegal, but it's wrong, right? So the index companies or whatever are claiming we did nothing illegal, Cory, right? Even though these companies are blacklisted because it's an index, we didn't break any laws. But my point is, they are still wrong. And what's crazy, Cory, is there was something like 6 of such companies in some of these indexes. So it wasn't like it was one. So my question to you is, why would you ever do that? Why would you ever invest your money in something that you don't know what it's invested in?
I don't really have a good answer to that.
That's
the best answer I can come up with is because maybe somebody told me it was a good idea, but that doesn't mean it is.
Your used car salesman, financial advisor said, let's just do index funds. And they went on to the next person and put them in index funds. So that's the problem, Cory, that these index funds, again, I think they originated many years ago with good intentions. I think that water has gotten muddy. And now many of these brokerage firms will let you buy fractional shares. So you don't even, if you don't have enough money to be diversified, you could buy 1/10 of a share of Microsoft, for example. We don't really do that at Falcon Wealth Advisors because it doesn't apply to our clients, mostly. However, you don't need to buy an index fund. And if you do buy an index fund, My argument is you need to know, or your advisor who's selling you this index fund needs to know every single position in that portfolio and why it's there and how it's going to contribute to your financial plan. And that's why we buy individual stocks and bonds, because we know why every single position is in the portfolio, Cory, and how it's going to hopefully impact or influence or be diversified according to a client's financial plan. That's why we don't use index funds. Good one. Another good one, Cory. All right, let's go to the next one, unless you got anything.
I have one question for you about this, Jake. The probe that was occurring, was it being done on the companies that have issued these index funds?
Yeah, I think, well, yes, the index, I think the index themselves and then maybe the funds that were, I think ultimately the funds, the product manufacturers are the ones that were brought up. And I don't want to call out any names on this show.
Sure. I just wanted to understand. Okay.
Yes. So again, that's still a problem. All right, let's go on to the next one.
All right.
Strategist Daily Macro Brief. What do these guys got to say, Cory?
Yes, this was really interesting. Dividend growers provide higher returns with less volatility. So to sum this up and keep it brief here, Jake, now that there are big tech companies that have initiated dividends, it's really happened the last couple of quarters, it's clear that dividends are gaining traction among some of the biggest companies in the S&P 500 that we've talked about here today. What I thought was really fascinating about this, though, is this analysis went back to 1990, and it's through the end of the first quarter this year. So 1990 through March 31st of 2024. And companies that have a history of growing their dividends have provided higher returns and lower volatility than companies that pay no dividend at all, at companies that haven't adjusted their dividend, or companies that have cut their dividends. So the point in all of this, the bottom line here, is that higher returns and lower volatility are the two things that most investors want. And with the introduction, frankly, of the buyback tax and the potential for it to move higher, their perspective was that dividend-paying stocks could be beneficiaries of that in the years ahead. My perspective is that they belong in a diversified portfolio, but it really fascinated me that companies growing their dividends have performed better than virtually any other companies over a long period of time.
Yeah, no, and that's good. And that's a good study to have and know. And again, part of our investment policy statement is to have those types of companies in our portfolio. So certainly, I'm glad you brought it up. Makes a lot of sense. I don't think an entire portfolio should only have dividend stocks necessarily.
Right.
So I like to have growth just to be diversified. However, it's just another case of why we like dividend growers, particularly companies that have a history of increasing them. That's good.
Yep. All right, Jake, how to not invest in the bond market?
I love it. The Wall Street Journal, Cory, reported on this. They basically said, don't buy bond funds, which, as you know, Cory, we don't do. So here's a premise, though. People thought the Fed were going to cut rates, and they didn't. And if you're in a bond fund, you're susceptible to other investors selling, and you don't have much control. Again, another reason we don't use funds, index funds, mutual funds, whatever. So my point is also, or the point of this article is also, don't be so foolish to think you're wise enough to predict the future. Instead, it says buy individual bonds, ladder out your maturities. And you know, old saying that a former colleague of ours told us, Cory, when you buy the ladder, rates don't matter. So the idea is with our clients, we want to buy a bond that matures in 1 year, 2 years, 3 years, 5 years, like rungs of a ladder, so that we're always having money maturing every year. And that way, if the Fed zigs or zags, our clients aren't overly exposed. They're diversified. So just like we always talk on this show about diversifying stocks, you want to diversify your bonds also, but you don't want to use a bond fund. The bond fund manager doesn't know anything about you, nor probably do they care. Instead, your friends at Falcon Wealth Advisors will hand select those bonds for you and build out an appropriate bond ladder. All right, Cory, we got time for one more.
All right.
How the stock market impacts investor mental health.
Yes, I just came across this one, Jake, and wanted to share it. Recent studies have found that there is a correlation between stock market downturns and an increase in hospital admissions for mental illness, an increase in domestic violence, deteriorating mental health among retirees, and increased depression rates. So this is what this data did.
Hold on. Is this a coincidence?
I don't think so, because of the data. There's so much data that was evaluated as part of this, and
was there a chart?
No charts.
Okay, all right.
No charts, Jake. The bottom line though here is that the market influence, and really the point that was being made from this too is that the market influences investors' moods, and investors' moods in turn influence the market. And really all of this points
Hold on. Say that again.
The market influences investors' moods, and then
Okay.
investors' mood in turn influence the market.
You think investors' moods influence the market because they buy or sell based on their moods?
That was the thesis of this study.
Okay. Keep going.
Basically, that when things are going well, people have a tendency to think they're going to keep going well, and when things are going poorly, people think they're going to keep going poorly,
Right.
and they make
Which is
decisions
wrong.
based on that.
Which is wrong.
The takeaway, though, here, and I want to be crystal clear, is, the point was made in this study also that all of this demonstrates clearly the need for a well thought out financial and investment plan, and recognize that it's a virtual certainty that you will experience periods of poor performance. You will experience periods of volatility. Being prepared and allocating properly for that is a big part of what it is that we do for our clients. But the point there is that should really help to minimize, having a plan in place should help to minimize the risk of making poor decisions that are triggered by emotions, particularly when it comes to your money. And it should also lead to...
Hold on. So why do you think then, all right, we know this and our clients know. Our clients know when they invest in stocks, it's going to be volatile. Why do they still get upset? Why is that?
Good question. It's a good question. I think
you don't have any idea.
My answer to that is expectations. I think people understand that. I think people understand the market's going to be volatile, but they don't know what that means.
Yeah, and I guess it's our job to help educate them. I think also recency bias
absolutely
is ingrained in humans. I think domestic bias, like if you tell someone list off 10 stocks, more than likely they're going to list off 10 American stock companies. However, the world is global. Like a true portfolio should be globally invested, but they're almost always. You ask somebody in China
or Canada,
what?
Or Canada, wherever.
Canada. Yeah. I'd ever tell you that I played golf with a guy who's a financial advisor in Canada, in Mexico. Okay, I'm in Mexico. I'm playing golf. Meet this guy. He's an advisor in Canada. I asked him, how much of your portfolios for your clients are typically Canadian companies? And I forget, but it was a lot. It was significant, 60%, 70, 80%. And I thought, isn't that fascinating how now there's some currency issues there, right? So that makes sense. But he's literally like just across the border or whatever. I don't know where he lived, but his clients' portfolios are completely different. So anyways, I thought that was fascinating. So that's a little bit of a tangent. I think, though, recency bias, people forget. Like, because I'll show clients all the time. Like, I always like to zoom out and say, okay, you've been a client for 5 years, 7 years, whatever it's been. This has been your average annual return. Here's when COVID broke out. Here's the dips. But look, you're hitting, if they are, look, you're hitting your target return. But it's almost always, Cory, don't your clients want to see year to date or the last 12 months? And I'll show it to them. But I'll also remind them that it doesn't matter. Sometimes clients will even say, oh, it's down today. And it's like, that really doesn't matter.
Right.
And true, it's an observation. I'm not saying that observations are wrong or don't matter. I'm just saying I hate to hear that stock market volatility influences mood. It shouldn't.
Evidently it does.
All right, what else do you have? Did you have more?
That was it.
Yeah, so
that was it.
So we've concluded that it might be recency bias is what's influencing that?
Yeah, recency bias, and I think a lack of expectations around what volatility means. Because you mentioned it when you zoom out, Jake, and how you cover this with clients. In March of 2020, when COVID broke out, the market crashed 30% in a month. And the average daily move in March of 2020, the average move over the whole month was 5%, which is crazy. That's big moves.
That is
the point
crazy.
There, though, is that's volatility, and that's extreme volatility, but how quickly we can forget.
Yeah.
And I think that's the big takeaway here.
I want to hear from our audience. If you want to email Luke at falconwealthadvisors.com, I want to hear if you have an opinion on that. Like, hey, I hear what you guys are saying, but this is why when the market goes crazy, I get upset. I want to hear that because hopefully we can, shed some light on that on Upticks and say, okay, I hear your concern. It's valid, but let's think about this and let's think about that and let's go back to this. So I want to hear more of that because Cory, you and I talk about this all the time with our clients, but I want to hear it from our audience. So please feel free, email Luke@FalconWealthAdvisors.com. And we'd love to hear more about why the market freaks you out when it's volatile. Let's talk about it. Let's talk about it on our show. So Cory, we got to wrap up. So thank you again for joining me. Thank you all for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, FalconWealthAdvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.